Hello guys, the chapter that we're doing now is called as depreciation. This is the first chapter that you have in your textbook. Now, what do we do in this chapter? Basically, the depreciation as per Companies Act is little different from depreciation as per IT Act. So, if I have to give you an example as to how it differs, say in your Companies Act, if I have purchased the asset on 30th of March, then I'd be charging depreciation only for 2 days, that is 30th and 31st of March. And there you bifurcate with respect to every asset that you have. You'll be seeing every asset and then charging depreciation. But here, as per IT Act, what does it do? IT Act won't give you all that benefits, all that luxury. What it tells, if you have purchased before 30th of September, then I'll give you full depreciation. If not, then I'll give you half depreciation. And before doing any of that, here basically will not bifurcate between different each and every asset. What I do, I'll see if the nature, usage, and rate of depreciation for that asset is same or not. If that is same, then I'll call that as one block of assets. Say, for example, if I have buildings, if I'm a person who deals with buildings that I give out uh, buildings on rent. Say if there is any residential property that I give out on rent, or if there is a commercial property that I give out on rent, I'll be seeing the nature and usage of such kind of assets. Say all the residential buildings will be considered as one of the block, all the commercial buildings will be considered as separate block. So this is how the assets are basically bifurcated. After that, there are certain major assets that I've given here for which the depreciation rates is also given. It's better if you all can remember at least this items. Say in that first one is residential building that has 5% rate. Non-residential building will always have 10% rate. Furniture is 10%, plant and machinery is 15%, vehicle is 15%, computers will have 40%, and intangible assets will always have 25%. Now, with that said and done, there are certain case scenarios where I'll not be charging depreciation at all. In that, one of the example is, say, how I calculate my block values. First, I'll be adding up opening WDV plus my additions. Now, this is the amount that I get. Once I get this amount, if my sale value, if there is any sales that I have made and the amount that I've received during the current period is greater than whatever value I have already got here, that is opening WDV plus additions. If that sale value is greater than whatever amount I have here, then I'll not be charging depreciation. The second case scenario is, say, for example, I have 5 residential buildings that I give out on rent. And if I'm selling out all 5 assets, say the value of such assets was around 5 crore rupees, but I'm selling all the 5 buildings for 4 crore rupees. Even then, I'll not be charging depreciation now because there is no block, there is no asset remaining in the block at all. So these are the two case scenarios where I'll not be charging any depreciation. After that, this is the format that I'm going to use when I'm supposed to write any answer for this question. That is, first you'll be taking the opening WDV. That means on April 1st of the current year, whatever is the value that I have in the beginning of the year, that will be considered as opening WDV. For that, I'd be adding the additions that I've done in the current period. See, you have to be very careful as to what is current year given in your question. Once you take that, I'm going to reduce the deletions for the year. In this deletions, what will I do? I'll take the deletions only for which I've got the money. Say if the asset got destroyed because of fire. If it is destroyed, I'll not take anything. But if I'm getting any amount from insurance company, then I'm going to take that as deletions because I'm getting some money out of it. So only then I'll, even if I'm selling or even if there is an insurance claim made, if at all, if I'm getting any money back, only then I can consider it as deletion. That is one thing. After that, whatever amount is remaining, for that I'd be doing depreciation for the current period. Now, how do I charge this depreciation? For this depreciation, what I do, whatever current year ka additions I have, say right now, this XXS value is say around 5 lakh rupees. This is an assumption that I'm making. This is total asset value. The current year additions, let me take current year addition as 3 lakh rupees and old assets being 2 lakh rupees. Now, if this current year additions were made after September 30th, that is after first half of the year, then the rate of depreciation I'm supposed to apply will become half of whatever is the rate given here. Say, if I have to give my example very clearly, imagine that this is a building which is of non-residential in nature. So what is the normal rate of depreciation I'm supposed to charge? That will be 10%. In current year, imagine if I have bought the asset in March. Now what will happen? This 3 lakh will be having the depreciation of 3 lakh into the rate is 10% into 1 divided by 2. I'll not be charging full year's depreciation. I'll be charging only half year's depreciation. Now, for the old machinery, old asset, what will I do? 2 lakh rupees into, say, complete 10%, because this asset, I've been using this asset for a long time. So the addition of both of this 15,000 plus 20,000 will be considered as depreciation for the year. Once I reduce that amount, whatever amount I get is called as closing WDV. Now, imagine if this asset was bought in the month of, say, July. If I bought this asset in the month of July, now what will happen? That means this asset I've used for more than half of the year. That is, asset is bought before September 30th. So here I'll not be doing 1 divided by 2. I'll just keep it this way. The total of this will become depreciation for the period. Now, in addition to that, one more thing that you have to study is, say, here we have this is the basic format for any kind of asset. Now, if the asset is plant and machinery, you have to be careful about one additional concept here, that is plant and machinery that is used for the sake of manufacturing purpose. Now, if there is any plant and machinery that is used for manufacturing purpose, there is one additional benefit given. What is that additional benefit? In addition to the depreciation that they've told here, I have one more concept called as less additional depreciation. This additional depreciation will always be at the rate of 20%. This amount I'm going to reduce. After reducing this amount, whatever value I get, that will be called as closing WDV. Now, this 20% will be the whole year's depreciation. If at all, if this asset was purchased after September 30th, this rate of depreciation will become 10%. Other than that, nothing else is going to change. Now, this is what you do in existing scheme. Now, if it is alternative tax regime, what will happen? Everything else is going to be same except for this additional depreciation. This will always be 0. Other than that, everything else is same. I hope the concept is clear by now. If there is any other doubt, please put it in the comment section, or you can put a message to me in the group. Done.